Hello again, this is Alex with MasterChartsTrading.com, and this is market recap for Friday, January 20th, 2017. So again, we're trading very close to all-time highs, and in fact, NASDAQ and the technology ETFs did hit all-time highs. We'll look at S&P 500, which has 3 inside weeks in a row. It's kind of interesting pattern, very tight consolidation. We'll look at small caps, which could easily break to all-time highs, and we'll go at some of the other sectors within the S&P 500. We'll look at bonds with a little bit more detail. We'll look at IEF, the 10-year treasuries, which I don't normally look at, and then we'll get into the Forex universe with the dollar, euro, pound, and the yen. We'll analyze those. Gold runs into resistance. We'll see where that goes from here. And the same thing for oil. I mean, it did gain a little bit, but we'll see where it goes from here also. And finally, we'll finish with natural gas, which I think still is correcting within a bigger uptrend. All right, let's move on to S&P 500 ETF SPY. This is a daily time frame with dividends added back into the price. In other words, total return for the index. So we hit all-time highs actually a week before, and since then we're just kind of trading in a range. In fact, this entire range from even mid-January, mid-December, there is a relatively tight trading range, and on the next chart I'll show what I mean by a tight trading range, and the weekly chart is a little bit more clear. Here what I wanted to point out that this is advanced decline line for the S&P 500, and just a few days ago we hit all-time highs on advanced decline line, so I see no major issues with this chart. These are all-time highs, and they are being confirmed by a broad rally in stocks. Here's what I mean by the consolidation trading range. So basically S&P 500 here, and this past 3 weeks, I'll zoom in a little bit, it's kind of easier to see. So past 3 weeks we basically had 3 inside weeks. So in other words, this first week, second week, and third week, you can see they're inside each other's trading ranges. So you can think of it also as a triangle consolidation. Now in clearly bullish security like S&P 500, a triangle consolidation with a subsequent breakout usually means continuation pattern. In other words, this is a continuation pattern before we see another move. And you know, we could easily see another move because we had a breakout about this much, so about 4%. So we could easily see another 4% move if we break out above this triangle consolidation. This, 3 weeks in a row of inside wicks is actually quite uncommon, and if we do break out, this could be a relatively strong move. This is Dow Jones Industrial Average on a daily time frame. This is without the dividends, but in any case, all-time highs, very strong move from November lows. This is about, of the lows to the highs, about 11, almost 12% move. So obviously a very strong move. I don't know. It's possible we'll just continue higher. Also, it's possible we take a little bit of a breather. Right now, the Dow Jones Industrial Average, the advanced decline lines and advanced decline volume lines have not hit all-time highs and did not yet continue highs. There is no bullish divergence as opposed to S&P 500, whereas there is a little bit of a bullish divergence. At least we're seeing all-time highs in advanced decline line. The Dow Jones has not done that so we could still continue sideways and possibly maybe a little bit pull back before a fresh push to all-time highs resumes. I don't think I'm not even contemplating a reversal, for now. I think we're still firmly bullish. Here is QQQ, the daily time frame, the NASDAQ 100 ETF, all-time highs, 2 days in a row. This entire week we're basically hitting all-time highs. So I see no issues as far as this security being very bullish, basically. Advanced decline line also is confirming all-time highs, so there is no divergence here. I don't see a divergence. There is good volume as well. Even unbalanced volume is clicking close to all-time highs, and I think the advanced decline volume line also very close to all-time highs. I mean, we got 22.8 thousand, we got 22.7, so very close. So I don't see major issues here just yet. Here's XLK, the technology ETF, also all-time highs. So the technology is doing just fine. The participation is broad. You can see the advanced decline volume for XLK did hit all-time highs, so, and also advanced decline volume. So I see no divergences here. This is really good news as far as the risk on posture, because XLK is a riskier ETF than some of the other ones. Here's IWM, the Russell. I think this one has been taking the brunt of, I don't know if I can even call this selling, just a little bit of a downward pressure in prices. But, it's already a little bit overextended to the downside. So we could easily just bounce off this 50-day moving average and continue higher. This is pretty bullish chart to me. Still, I see no major issues with advanced decline lines just yet. Now let's go over some of the major sectors. Here's XLF financials. Last week we hit all-time high. As I said, it was a little bit of a rejection look here. On Monday we did gap down and pushed lower. How much of a selling was quite muted, I think, this week, so we more or less finished basically flat. I don't see any major divergences either, so this is, if anything, if we pull back a little bit more, this could be a buying opportunity, if anything. In fact, here's consumer staples. If you listen to some of my previous videos, I said that this dip here was probably a buying opportunity, and lo and behold it is. So now we are again hitting all-time highs, and this is just this week. Here there is a little bit of a divergence. I see a little bit of a bearish divergence, so maybe it's a little bit overextended and might pull back a little. Industrial is one of the strongest sectors and strongest performers. All-time highs, all-time closing highs. Actually, no, all-time closing highs were here, back here. But in any case, all-time highs are important and speak volume. Speak volumes rather. No major divergences here either. So I think maybe we'll get a small pullback, but then most likely we'll see another breakout. Okay, now we're getting into a little bit of a laggards. Here is XLV, the healthcare ETF. This one just basically goes nowhere for the past few months, more or less. However, I wanted to point out that these are all-time highs in advanced decline line, so this is a bullish divergence, and we could see a breakout higher for this sector. In fact, last week I pointed out a bullish divergence in XLP, and this is consumer staples. Last week we finished the week, I believe, right here, and I pointed out this bullish divergence. In other words, the advanced decline lines are already were already breaking out above the previous highs, but the index itself was still down here, and I said that I would not be surprised if powers that may be decide to pour some money into XLP. And here we go. We are breaking out above 200-day moving average, and this is a 3-month high above previous peaks here in October. Now, consumer staples are a bit of a defensive sector, so maybe we're seeing a shift towards the defensive sector for a reason, because maybe this rally of the November lows is getting a little overextended. So possibly we'll see a shift of money into defensive sectors. That does not mean that the entire stock market will come under severe pressure. Here's real estate, doing just fine again. Didn't really do much, kind of traded sideways, but it's fine too, I think. So I think still this is a bullish chart. If, let's say, maybe you can think about it as a value chart. It's not necessarily a breakout. It's not necessarily a growth play, more like a value play. Same goes for utilities. This one, like XLB, that attempted to break out here, but then we had a bit of a sell-off in bonds, so the utilities came under pressure. I'll talk about bonds a little later. I think utilities are bullish also. I think we will see a push further up from here. All right, and I decided to lump the junk bonds together with stocks, just because they pretty much trade like stocks and they have high correlation to the stock market. So junk bonds finally took a little breather and did not hit all-time highs this week, but they're trading within a couple of, not even percentage point of the all-time highs. Junk bonds are basically like stocks almost. You can see correlations are very high to the stock market. But anyways, the strength in junk bonds is good for the stock market, so I think this is another positive sign for the stock market and another piece of the evidence to think that the stock market is bullish, and I don't see any reversals for now. All right, let's move up the quality ladder. This is LQD, investment grade corporate bonds. So if you listen to some of my previous videos, I thought that we had the reversal in bonds and we possibly we're in a bear market. Now, I am less certain about this right now for various reasons, and we'll try to go over some of them right now. So here this is a daily chart of LQD, by the way. So we're seeing here some significant selling with a gap down, continuation lower, but finally we were able to bottom out basically, and we had a sizable rally here. And now the bears came out, well, or possibly we just saw some profit taking. I'm not sure exactly what's happening here, but we did see some selling here. So anyways, what I'm seeing here right now is that I don't see, like, the bears came out, but they didn't come out swinging. It was just kind of a little bit of a push. So I wonder if this is a bit of a bear trap. And I see maybe a little bit of a buying presence here, and this is pretty good looking hammer candlestick. So I'm not exactly certain if this is like a bearish push and we will see new lows. I think we may actually see buying here, and we may actually reverse and continue higher. Here's the same chart on the weekly time frame, and this one I cannot even say that this is in a bear market because these are all-time highs and these are not 52-week lows. So this right here, December lows, these are the lows right here. So it looks like we did find support when we rallied. Now we had this big red candlestick, and looks like everybody would say, but look, this is a bearish engulfing candle. This big bearish engulfing engulfed this entire candle, the previous candle. Additionally, this is a outside reversal. And I would say that this is correct, but I'm not sure if the bears are indeed going to continue this push. Maybe this is already being smart investors are basically buying at a relatively low risk to this low for a push higher. In fact, let me go on to the next chart and I'll show you what I mean. Here's IEF, the 7 to 10 year Treasury bond fund. I don't normally look at this one, I look more at TLT, but I thought I would mention this one right now because this one, unlike TLT, had a hollow white candle here. So again, I see some buying pressure here, similar to the one I just showed for LQD. In fact, let's go at IEF. Here's a weekly chart, and we did get a lot of selling here. Very steep drop. I'm not going to argue with that. Is this a true reversal? We will only see this in the rearview mirror. What I see here, though, is that these are not yet 52-week lows. So again, I cannot say with 100% certainty that we're in a bear market. And the important thing about this chart, so let me show you what I mean. Here's a very useful indicator called ATR, average true range. So ATR shows on average how much the security move per time in question. So for example, in this case, since this is a weekly chart, per week on average, this security moves about $1.226. So if we measure from the low of the week to the low of the previous week, we see that we're basically about one average true range away from the previous lows. So it's possible that smart money is already buying at these levels here, basically, because their risk is very low, but their potential for reward is quite high. Because let's say you buy down here, your risk is 1 ATR, $1.20, but let's say it continues higher, so $1.20 is right there, and it's easily a break-even trade. And even further about here is your 2 times ATR. Here's your 3 times ATR. So around here, around 108.70 or so, it would make sense to 109 here. There's a gap here, so that's probably where they would take profits. So I'm now actually more questioning the entire premise in a bear market in bonds, and possibly we are not yet in a bear market in bonds, basically. Here's the same thing for TLT. This one I look at more often. Very large volume here. This candlestick is not terribly bearish. This is a daily candlestick. It's a hollow red candle. So I wonder again if we're seeing buying because we're relatively close to this low. So maybe smart money decided already to go in and start buying. And here's that same chart on a weekly time frame. This is TLT. See, this one is a little bit more volatile than IEF. You can see that we came down from all-time highs to 52-week lows. So here I was more certain that this is now in a bear market. But now I'm not as certain, because you can see that the ATR here is 3.25. We can measure from the low of the week to the low of the previous low. It's about 1 ATR. So smart money may be already going in here and buying at a low risk. So I wonder if bonds will rebound, and maybe that's the reason why XLP, the consumer staples, are experiencing a little bit of a better performance than other ETFs currently. All right, let's switch gears and move on to the Forex universe. This is US dollar index on a daily time frame. So beginning of the year, we hit multi-year highs, and then we basically corrected, and we've been correcting for the past 4 weeks. We had an attempt by the bulls here that so far was not terribly successful. So there is a lot of back and forth with various currencies. So this US dollar index. It's traded as DXY, and here it's just a like an index. It's not really a tradable instrument, although you can trade it in America as UUP, but it's not a 24-hour thing. In Europe and some other countries, you can trade it as DXY on the forex market as a contract for difference, CFD. But in any case, here so far the bulls have not been terribly successful, but I don't think the bulls are done yet. I think there may be a reattempt to push higher next week here. Weekly time frame, pretty obvious bullish chart. This is going back to 2014. Breakout above previous highs here. Huge long-term consolidation with a double bottom. Breakout here in November of around the election time, and now we're simply correcting back down to the breakout level. So whether or not we will hold here or whether we will continue with a deeper pullback is difficult to say, but I know that this is a bullish chart, so I probably would avoid, personally, I would avoid shorting it. Here's euro versus US dollar on a daily time frame. These were multi-year lows. If you listen to my videos, I said that the rebound is very likely. We are getting this rebound. On a daily time frame, it's kind of difficult to see. So let's go to weekly. Here's euro versus US dollar on the weekly time frame. I pointed out this four attempts to go lower that were rejected. So we have 1, 2, 3, 4 attempts to go lower that so far were rejected, and we did rally for the past basically 4 weeks. Where we go from here, again, it's difficult to say. This is a bearish chart, long term. This is a weekly, so it takes a long time for these patterns to play out. But usually when we see multi-year lows and we see a rebound, maybe a little bit of rebound and another plunge lower. Now, so far on this chart, I don't see bears taking too much initiative. So maybe they'll need to try again, possibly around these spikes here before from December. Big story, of course, is British pound. Just a very big candlestick here. This spike is very large. So if you are, well, let me go to weekly chart. I think it's a little bit more obvious. The same thing as I just showed with TLT. Here's average true range for British pound versus US dollar, and this is a weekly average true range. So we got about 0.338. Now the lows of this week. It's relatively reasonable to risk 2 ATRs and buy at this level here. So we're about 2 ATRs from the recent lows. So possibly we see some buying because just because of the low risk entry. So we may see a little bit more upside. I don't know if we reversed, for British pound versus US dollar. So far, I still see this as a bearish chart. And we need to see at least maybe a higher low and then a higher high and then a higher low and then continuation. For now I see a bearish security still. Finally, here's the US dollar versus Japanese yen. Now this one is now a bullish security, I think. So in other words, US dollar is winning versus the Japanese yen. We got to resistance area from previous trading here. I pointed it out. Here's the previous trading, here's the resistance. We pulled back, and looks like now we're attempting to bottom. And so far the bulls have not been terribly successful, but it looks like we may continue higher from here. It just depends on the many circumstances. All right, let's move on to gold. Okay, here's gold on a daily time frame, continuous contract. Impressive rally of the lows here in December. I said, I pointed it out, this is a V-shaped reversal for now. V-shaped reversals are not terribly common. They do happen, but they are not terribly common. So right now we're seeing resistance in the $1,200 area. I mean, you can draw resistance lines. There are so many of them here. You can see there is resistance from this big candle, this big volume. So there is a lot of resistance here, and I don't know exactly where to draw it, so I put in this big resistance zone. So far it's been reaffirmed here, and I don't see gold still with a breakout. Don't know if what's going to happen in the future, but it's possible if the dollar decides to rally from here, gold will absolutely come under pressure because gold and dollar are inversely correlated. Here GLD on a daily time frame, we did close a gap here, so that's positive sign, but just like I showed, we are seeing resistance here. In fact, here's that Friday today's candle. During the day it looked beautiful, it looked like we're gonna close above 115, but then the very last few minutes we sold off. So I think we're still seeing I think we're seeing bears take positions here, and possibly we will see a corrective action here. And here's the weekly time frame for gold. There's that candle, but in the weekly time frame we did gain a little bit for gold, but this is looking more and more like rejection type of candle here, and it looks exactly in the resistance. See, we had a breakout above the previous highs right there. Correction 1, correction 2, 52-week highs. Now this became a good support level, but we broke it at 1200, so now it becomes resistance, and so far I don't see a breakout above resistance. Long term, this is one of my proprietary market breadth indices. I still think we're in a bull market for gold, and the breadth has improved a little bit, not so much that I can say that we're all clear, but it has improved, let's say, from just a couple of weeks ago. So we are getting a little better. Hopefully we'll see this index finally move up to 3. So far I haven't seen it yet, so the numbers are not yet there, but we are attempting, so that's at least a good sign. This rally of the lows is certainly looking a bit overextended, so I would not be surprised if we roll over here. GDX, just like gold, is running into resistance, but in its own universe. Plus, it's a very, you can see it's very choppy chart, so it's significantly different. But there is a little bit of a bullish divergence here. The index has made a higher high, but the underlying breadth has not, or rather, let me refresh. The index has made a lower high relative to this high, but the underlying market breadth data has indeed made a higher high. For example, here is a bullish percent index, so it is looking better and better. I would feel much better if gold manages to conclusively break above $1,200 on a weekly basis, maybe pull up here and maybe like consolidate sideways. Right now it's still quite shaky, and it's entirely possible that this would be it and we'll just collapse back down. If we do that, then this bull market in gold could be questioned. And here is the weekly time frame for GDX. Same thing, the weekly, you can see that GDX started its run a little bit earlier than gold. Here is gold. This week was still red for gold, but this week was already black for gold here. So looks like we are attempting to break out. It actually closed above previous resistance at 2312, above this high from 2015. So it is looking positive, but these two candles are black filled, so not terribly inspiring, I guess. It will depend on gold and especially on dollar, where we go from here. And this another chart for GDX on the longer term time frame showing the market breadth index for gold. So far, I have not seen an improvement in GBI. Hopefully, we'll see it next week if we see a little bit more upside for gold. All right, moving on to the hard commodities. This is West Texas Intermediate light crude oil on a daily time frame. So we had 52-week highs a couple of weeks ago, but we had this big bearish looking candle and a bit of a sell-off here, a rebound, continuation. I mean, so far the bears are having a bit of a trouble, I guess, here. The bulls really need to break out to fresh 52-week highs to negate this rather bearish looking candle. For the week, oil did gain a little bit, but the gain is rather muted, so kind of went nowhere really. Neither the bulls nor the bears could really push the prices much. Here's another clue to this puzzle. This is energy, XLE. We did hit 52-week highs, so I'm more inclined to think of it as a bullish chart. Now we're pulling back from 52-week highs as oil corrected as well. Actually, is more sensitive. You can see that correction started here on the 12th of December. While the correction here started in the beginning of January. So XLE pulled back, started the pullback earlier. Here my major concern is this advanced decline line. You can see it's not nowhere near to all-time highs, and I just showed what I mean by advanced decline line confirming S&P 500. In this case, you can see that it's only the major hitters, so in other words, advanced decline volume line did hit all-time highs, or 52-week highs in rather. So a few stocks that are big, for example, ExxonMobil, etc., are pushing higher, while the majority of stocks are not really participating in the advance that well. So I wonder if we see a further correction in XLE, and because you can see there was very feeble attempts by the bulls so far this week. So I wonder if we'll see further correction in XLE and by extension in oil as well. And here's natural gas on a daily time frame, continuous contract. These were 52-week highs here in December of last year. We pulled back very sharply with a big gap, continued lower. Is this a bearish chart? I don't think so. Still, I think this still is a bullish chart. I mean, this thing is wild. You can see how much it corrects. Sometimes it just pulls back very sharply, but then it rallies again. So for now, I still think that this is a bullish chart, and I will be looking to go long. In fact, here is natural gas on a weekly time frame. 52-week highs. Here's that pullback I mentioned. We had a hammer-like candlestick, but then this week was just big red candle. So I wonder if this low will be broken. If this low will be broken, I don't think this is a bearish chart still. I think that, if we correct all the way to $2.50 and break that, then I would be significantly more worried. Here I'm not that worried still. I think there is excellent support at $2.50. Alright, if you like what you're hearing, please consider signing up at MasterChartsTrading.com, and also please like the video. It will mean a lot to me if you do so, and if you have any comments, please do enter the comments as well. Again, thanks for watching, and have another great trading week. Bye-bye. So I wanted to show you how to find us on the internet. Please go to MasterChartsTrading.com. We do have a trade alert services which are live right now, so please consider signing up for the service. It's only $24.95 per month. Also, if you sign up for our mailing list, you get a discounted membership. You get to see what I'm buying and selling and which funds I'm looking at, potential buys, sells, etc. There's quite a bit of members-only content once you log in. There's a lot of information about risk control, which is actually extremely important for traders, because the preservation of capital is really one of the paramount to the successes in trading. There's quite a bit of psychology of videos, psychology of trading videos in the members only section as well. Also, I'm going to be starting a Dividend Aristocrats service. For now, it's free for the members that are logged in, that are already paying members, so that's another benefit to signing up soon. The blog section shows the previous posts and market videos, of course. Also, I've added a new section here, which is FAQs, and I do get quite a bit of questions about various, ideas and questions about the market. So if you do have a question, please don't hesitate to send it in. Send it here, and I'll be hopefully I'll be able to answer it for you. All right. Thanks for watching, and please consider signing up for the trailer services. Bye-bye.